in late 2009, while the global financial system was crumbling and panic swept through Wall Street. The most famous investor in history made a move that left financial analysts completely speechless. Warren Buffett didn't buy hypergrowth tech stocks, he didn't buy gold, and he didn't hoard cash in a safe. Instead, he wrote a single check for $44 billion, buying an old, dirty, 19th-century railroad company called Burlington Northern Santa Fe, better known as BNSF. Wall Street commentators publicly scoffed at the deal. They called it a massive blunder, an outdated play on a dying American manufacturing base during the worst recession since the Great Depression. Financial television hosts asked how the world's sharpest investor could sink tens of billions into heavy steel and diesel locomotives when the future was clearly digital. But Warren Buffett wasn't guessing. He saw a hidden economic engine that Wall Street was completely blind to. Today, that single decision generates billions of dollars in pure cash every single year, creating one of the most profitable financial fortresses in human history. So, what did the Oracle of Omaha see that everyone else missed? And how does a business model built before the invention of the light bulb consistently crush modern tech giants in cash flow generation? To understand why Wall Street was so dead wrong, you have to look inside a quiet office in Omaha during the winter of 2009. The world was watching major banks collapse, real estate values evaporate overnight, and unemployment spike across the country. Everyone was terrified of what tomorrow would bring. Yet, while hedge fund managers were frantically selling off their portfolios, Buffett was sitting back, quietly studying a simple logistics map of North America. He realized something fundamental about human survival that short-term traders completely overlooked. No matter how severe an economic crisis becomes, human beings still need to eat. Power plants still need coal and natural gas. Factories still need raw chemicals, and stores still need goods on their shelves, and across the entire American continent, there was only one single physical network capable of moving those massive volumes of commodities at scale. When Berkshire Hathaway finalized the purchase of BNSF, Buffett called it an all-in wager on the economic future of the United States. But behind that patriotic headline lay a cold, calculated investment framework known as the economic moat. In the world of professional investing, a moat is a structural advantage that protects a company from competitors. Just like a wide trench filled with water protects a medieval castle, if you build a wildly successful software app today, a clever developer sitting in a garage can write better code tomorrow and destroy your entire business overnight. Look at history. Look at Kodak. Look at BlackBerry. Look at Yahoo. Silicon Valley giants spend tens of billions of dollars every year just defending their market share from the next wave of disruptive innovation. Their moats require constant, expensive maintenance just to keep competitors at bay. A freight rail network, however, is completely immune to technological disruption. You cannot download a physical freight train, and you cannot disrupt 32,000 miles of continuous steel tracks with a line of code. To build a competing railroad like BNSF today, a rival company would have to acquire hundreds of thousands of individual properties across 28 states. They would need to blast through mountain ranges, pave through densely populated metropolitan cities, and navigate tens of thousands of local environmental lawsuits. The initial capital required would run into hundreds of billions of dollars before a single freight train ever moved an inch, making new competition mathematically impossible. In the eyes of a legendary investor, that isn't just a business, it's an unbreakable physical monopoly that will exist for the next century. However, an unbreakable monopoly is only valuable if it can actually extract money from the economy. Which brings us to the hidden pricing mechanism that makes freight rail absurdly lucrative. Here is the financial dynamic that most everyday consumers never notice. When inflation hits the global economy, most businesses suffer terribly. Their raw material costs surge, employee wages rise, and they struggle to pass those costs on to customers without losing them to cheaper market alternatives. Freight railroads, on the other hand, hold a secret financial weapon known as inelastic pricing power. Imagine you own a major agricultural processing plant in the American Midwest. and you need to move 50,000 tons of harvested grain to a seaport on the Pacific coast. You cannot put that much grain on semi-trucks without paying 4 times the cost and trying to hire hundreds of truck drivers that simply do not exist. You cannot put it on an airplane, and there is no river system connecting your facility directly to the ocean. In the eyes of the railroad, you are what the industry quietly calls a captive customer. When BNSF or Union Pacific raises their freight rates, you don't shop around for a cheaper competitor, because a cheaper competitor literally does not exist in your region. You simply pay the higher rate, fold the cost into the price of food, and pass it straight down to the end consumer. And the financial protection goes even deeper than that. Railroad operators write automatic fuel surcharge clauses directly into their long-term corporate shipping contracts. If the global price of crude oil doubles overnight, the railroad doesn't absorb the shock or lose a single dime of profit. The contract automatically calculates the increased cost of diesel and bills the customer instantly, while other traditional transport industries watch their profit margins disintegrate during economic panics. Freight railroads see their revenues automatically expand alongside rising energy prices. They don't just survive inflationary periods, they actively profit from them. Now, passing on costs is a brilliant strategy, but to understand why cash piles up so fast, you have to examine how these companies manage their capital expenses. Wall Street loves businesses that generate what analysts call free cash flow. Pure cash left over after paying all operational expenses and infrastructure maintenance. For most heavy industrial companies, expensive machinery wears out quickly, requiring constant, painful reinvestment just to keep operations running. Steel rail, however, is remarkably durable when laid correctly. Once a main shipping line is constructed and routine maintenance is established, it can support hundreds of millions of tons of heavy cargo over several decades, because the baseline physical network was built and paid for generations ago. Every additional freight car running over those tracks carries a remarkably high profit margin. Economists refer to this phenomenon as incremental operational margin. Running 20 trains a day over a stretch of track costs almost the exact same amount in fixed physical maintenance as running 15 trains. That means every extra car added to a scheduled route converts almost pure revenue straight into bottom-line corporate profit. When Berkshire Hathaway took BNSF private, they stopped worrying about quarter-to-quarter earnings reports designed to satisfy impatient retail traders. Instead, they focused on capturing that massive free cash flow and funneling it directly back into automated infrastructure and stock buybacks. Year after year, billions of dollars flow out of rail yards directly into the central treasury in Omaha, funding new corporate acquisitions without taking on dangerous levels of high-interest debt. Yet, there is another critical piece to this business model that everyday investors rarely analyze: the explosion of global intermodal trade. You might assume that the growth of overseas manufacturing and global container shipping would create volatility that harms domestic rail operations. In reality, globalization made American freight rail significantly stronger. When massive cargo ships arrive at West Coast ports from manufacturing hubs across Asia, they don't unload onto highway trucks for long-distance transport across the country. Instead, those multi-ton steel shipping containers are lifted directly onto specialized train cars in what the industry calls intermodal transport. Railroads engineered a double-stack system where ocean containers are stacked too high on custom lowboy rail cars, creating long-distance land bridges that cross the continent in a matter of days. By connecting ocean shipping lines directly to inland distribution hubs, railroads transformed themselves from regional transit lines into mandatory choke points of global trade. A retail giant like Walmart or Target cannot import goods from overseas without paying a toll to a freight railroad somewhere along the supply chain. Finally, there is one last layer protecting this money machine: the ultimate regulatory shield granted by the federal government. Under United States law, freight railroads are overseen by a specialized independent federal agency known as the Surface Transportation Board. This regulatory framework recognizes that if the freight rail network were to break down or go bankrupt, The entire national economy would grind to a halt within 72 hours. Water treatment plants would run out of purification chemicals. Power grids would lose fuel, and grocery store shelves would empty across the country. Because of this critical national security reality, the government actively protects the operational and financial stability of the railroad industry.